10 reasons why the recession isn't coming soon. Before we start, I'd like you to hit that red subscribe button so that you never miss out on any of our videos. Hey guys, what's up? Welcome back to the Business Zone. A recession is unlikely in 2020, but it is possible. The economics profession did not predict most past recessions, so the absence of a downturn in current forecasts cannot be too comforting to business leaders planning operations for the upcoming year. Contingency plans for a recession continue to make sense, and many businesses' plans should reflect possible causes of a slump. This video will roll through the most likely causes with an evaluation of each. With that in mind, here's some reasons why the recession isn't coming soon. Number 1. Low unemployment. Unemployment in the US has been at historically low levels at around 3.5%. That means that relatively few people who want work are having trouble getting it, and it makes workers looking to switch jobs more confident in their prospects. That's a positive for the overall economy. Number 2. Strong stock market. Most popular stock market benchmarks are at or near all-time record highs. That points to the confidence that investors have some of the largest companies in the world, and it also bodes well for those who rely on their investment portfolios to finance their lifestyles. Number 3. Media focus is anywhere but on a possible recession ahead. Whenever the media narrow their focus on a common investment theme, they reflect popular investor thinking. Popular is not necessarily a contrarian indicator, but it can become one when the theme becomes extreme, for example during times of strong feelings. Based on today's media focus, the popular pessimistic view is that a recession is coming. Articles are plentiful, but most now offer little new information. Instead, they're reboots of the usual rationale, freshened up with some new economic report and a couple of new quotes. Therefore, media agreement about a recession coming has reached the point of being a contrarian indicator, meaning no recession is near. Moreover, this earnings season, with its rising stock prices and favorable earnings reports, is likely to be the catalyst that reverses investor feelings and media reports about the likelihood of a nearby recession. Number 4. Progress on trade negotiations with China. Trade tensions between the US and China have continued for a long time, but recent progress suggested that an end might be in sight. After the damage that tariffs have done to some parts of the economy, any relief could spell new growth for those businesses hit hardest by trade disputes. Number 5. The Coincident Economic Activity Index versus Initial Jobless Claims. The Coincident Economic Activity Index includes 4 indicators: non-farm payroll employment, the unemployment rate, averaged hours worked in manufacturing, and wages and salaries. The trend for each state's index is set to match the trend for gross state product. As it turns out, this index generally has an inverse relationship with initial jobless claims numbers prior to recessions. Initial claims rise, whereas the Constant Economy Activity Index drops. Or, in other words, they converge and often pass one another, just as it happened in 1990, 2000, and 2008. Number 6. Low tax rates. Tax cuts that took effect in 2018 will continue throughout 2020, reducing the amount of tax that individuals and corporations pay. The impact of lower tax rates might not be as obvious as it was when the cuts were new, but they'll still add a lot to profit for companies and let investors keep more of their hard-earned cash. Number 7. Economic agreement about a coming recession is absent. When economists agree that a recession is approaching, ignore the forecast. Economists analyze and evaluate reliable data, which is good for accuracy and insight. However, their expertise in understanding what has already happened, that skill, may seem to qualify them to make worthwhile forecasting. However, as a group, they fail particularly at foreseeing trend changes or usual development. Studies show that this inability to forecast is ubiquitous. Therefore, when there is a widespread and assured view by economists, it may be used as a reliable contrarian indicator. So, 100% guaranteed economists' shared vision of a recession approaching is a confirmation that no recession is near. Number 8. Modest recent economic growth. Economic growth in gross domestic product came to 3.1% in the first quarter of 2019, 2% in the second quarter, and 2.1% in the third quarter. These are solid readings, but they don't indicate excessive froth in the economy. Sometimes faster growth can precede recessions, but this rate of growth isn't so fast as to warrant concern. Number 9. A healthy housing market. Median prices for existing homes are up more than 5% from year-ago levels, with strength in regions across the nation. That's good news for homeowners, although low inventories are making it harder for those who want to purchase homes to find properties they want. After the housing crisis in the mid-2000s, home prices have been on a long upward trend, helping to boost the wealth of average Americans. Number 10. Business capital spending. The US economy gets support from businesses spending money in order to expand and create new opportunities. Tax cuts and other measures haven't achieved all of their goals in boosting investments, as many companies have instead increased dividends or stock buyout. Nevertheless, some industries have spent more to create jobs or boost production. recession, and that's likely to have a positive impact on the economy in 2020. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss out on any of our videos in the future. Also, watch the 2 videos that are currently on your screen, because I'm sure you'll love them. With that, I'll see you in the next video.